What's going on, everybody? Would you enjoy free shares of stocks? You can do so via collecting premium through the options of that stock. I'm doing this strategy on Google right now, and I'm going to walk through how I'm doing the strategy. So hopefully you all can do it yourself to help you generate some free revenue in your trading account as well. It's called the option wheel strategy. And while I just said, I just want to catch myself here, I just said free revenue. Nothing's ever free, of course, with any trade. There's risk to any trade you take, but this is a risk averse way to get into stocks that you already want to own long term anyway. I think that's the best place to start. Hit like and subscribe before we get into the video, by the way. I think that's the best place to start, though. What I want you all to understand is that if you're going to buy a stock, if you like a stock long term, I like Google long term. At this current valuation, Google is my favorite stock in the stock market. My actual favorite company is Apple, but Google has fallen down harder than Apple has. So at current valuation, Google is my favorite company. I want to own Google. I'm looking to invest in Google. But if I want to buy dips on Google, there's a way you can do it so that you generate extra income while you're waiting for the stock to get to your price. And you do that through selling options. You all have seen this in my videos a couple of times if you watch my live day trade recaps that I post every day. But I'm currently in a short put of Google. This put expires on November 25th, and its strike on the put is at $92. I'm currently, I sold it for a $224 premium, and I'm currently up $150. Let's just quickly cover what calls and puts and what selling them are. So puts, if you buy a put, you need the stock price to come down. It gives you the option to sell a stock at whatever strike price that you identify. So if Google on November 25th were to expire at 89, you would have the option to sell it to whoever bought it from you, or it's not exactly one-to-one who bought it from you, but you would have the option to sell that for 92. Vis-a-vis, you would make $300 in the difference there minus the premium. So you'd make about $76 because you lose out on the premium you paid for the option, right? So if you buy a put, you need the price to go down, and calls are the exact opposite. Everything I just said, flip it, that's a call to the upside. Now, I'm selling the put, meaning I need Google on November 25th to not expire below 92, and I'm going to collect this $224, and I'm going to move on with my life. Well, Trey, what happens if it does expire below 92? What if that same situation on November 25th, Google expires at $89? Well, guess what? I'm still going to collect the premium. I think that's the first very important thing to understand. As long as this option expires, this $224 is already in my account. I sold the premium. Now, if it expires at 89, just like I said, the put buyer would make $76. I'd still lose $76 in the trade, right? But it wouldn't be too bad. It wouldn't be as much as the option is down because I get to collect the premium because I sold the option. So then if that happens, I then own 100 shares of Google at 92, right? So it's currently trading at 89, but I would have to buy it at 92. But guess what? What did we start this video with? We started this video with do this on stocks that you want to own long term. I would be perfectly fine owning 100 shares of Google at 92. I'd be perfectly fine owning 100 shares of Google at 96. I actually started the strategy, and we're going to jump into my past trade spreadsheet here. I started the strategy selling 96 strike puts, but as Google has come down, I have rode puts down. And once again, we'll get into that in a second. But so I'm okay if it does expire below that, but while I wait for it to get there, I get to collect premium, right? I'm currently up $150 on this put, which is awesome. And as you can see here, I already owned, this is just straight common shares. I own 3 shares of Alphabet. I've been calling it Google. Of course, it's Alphabet Inc. I'm going to continue calling it Google for the rest of the video, but I own 3 shares of Google, and I didn't pay anything for these shares. Now, free. I throw the word free around. The shares are free. I still had to trade to generate the profit. I still had to write short puts, but let's go ahead and jump into it now. So this is what I've already done. The first trade I took was on a put that expired October 21st at a 96 strike, $240 premium. I collected $197. So the talk I just had about, okay, well, when it expires, you get to collect this premium. Guess what? You don't have to let it expire either. Just like when you buy options, most people, if not, it's very rare you see somebody buy an option and actually let it expire, right? For the most part, you trade the premium price on the option. I could do the same thing. I could go buy this option back right now and collect $150 of profit if I wanted to. Now, I don't want to. I think there's still more meat on the bones here. I want to let it get a little bit more, but I can exit this whenever I want to. So here, whenever it's, so I should have wrote the exact date down on this, but when it was up $200, there's $40 left of premium for me to collect, right? The max you can make when you sell an option is the premium that you sold that option for. So I think there was like a week and a half left before this option expired, and I was already up $200. I wasn't willing to risk a week and a half of time left in the option to try to collect an extra $40 on this. So I just bought the option back. I just got out of the trade, took my $200. Now, this next one, I sold a November 18th 95 strike. You may or may not know 11/18 was after Google earnings. So I sold it for 301. Guess what? The premium was higher because the implied volatility, and we'll get into that, from options was baked into the strike price. So the premium was higher, but I got out before earnings. That's one rule of the strategy. Maybe the first real objective rule I'm covering in the strategy if you have pen and paper. Don't hold through earnings. The number one way you can lose money selling options is holding them through earnings. That's the one thing that can really screw you. Earnings, I always say, are a crapshoot. Yes, you can have ideas, blah, 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 but for the most part, earnings are a crapshoot, so always get out before earnings. So that's what I did here. As you can see from my cool Excel math here, we're up $303 just from options, and we have spent $305 on the 3 shares I bought. So the actual out-of-pocket, out of my account money that I didn't trade using this wheel option strategy for is what, $2.58. Outside of that $2.58, these 3 shares have been generated for free from, let me start saying it this way, from trading profits by just selling options and collecting premium against a stock that I want to own. Anyway, I keep saying that a stock, if the first option I sold, it would have expired at 93 and I would have had to buy 100 shares of Google at 93, I would have been happy with that, right? That is such, I touched on this already. I know, I'm gonna repeat myself one more time though. Please do this strategy on an option that you want to buy anyway. It takes the fear out of it, right? Like when you sell a put, you get to identify a price that you want to buy a stock at. Hey, I want to buy Google at 96. I was doing that here. I want to buy Google at 96. I was doing it before earnings. So let's say here, oh, it didn't get there. Cool. I get to collect premium, move on, try it again. Let's see if I can buy it at 95. Oh, earnings are coming. Okay. I'm going to exit and collect premium. Oh my gosh, look, earnings crush Google. It's a good thing I got out of the short put. Okay, well now I want to buy Google at 92. All of a sudden it's trading back at 96. Yes, I did enter this trade right after earnings, and for a while there, I actually was down a clip on this, but I trust in it, I believe in it, because I want to own it anyway. I would have bought Google at 92. I would have bought 100 shares of Google at 92 no matter what happens after that anyway. So why not collect option premium against it, right? And now Google's back to trading at $97. I mean, absolutely insane run these last couple of days. So my option is now back to green, and I'm going to collect this premium, most likely. There's still time left, of course, but most likely I'm going to collect this $200 of premium. I'm going to get another 2 shares that I generate just through writing options, just through letting these things expire, writing options out. Let's actually change this. The current price of Google is now 97. As you can see, my share profit is down. My average cost is 101.86 on the shares that I bought, so that's slightly down. Total profit $288, and I've only been doing this for like a month. Now, I want to touch on this as well. Maybe I probably should have touched on this first, because maybe a lot of you guys are watching this video. Well, like, I'm not approved to sell options, Trey, so I can't do this. I'm doing cash secured puts. That means it takes the buying power of 100 shares away from my account. So it knows that, I mean, worst case scenario, Google goes to 0, then you lose $9,600 or $9,700. But it takes that buying power. I can't use that buying power. So the brokerage knows I have the cash available to cover if the worst case scenario happens. So yes, you can do it if you're using cash secured puts. This is not a naked put. I have cash secured on the back end. Now, what happens? So let's go ahead and touch. It hasn't happened yet, but what happens when I do get filled? What's the other side of this wheel strategy? It's got to be circular to be a wheel, right? The other side, I will get filled one day. One day I will sell a put. Google will tank. It'll expire beneath my strike price, and I will get filled 100 shares of Google. Then what can I do? Then I can go sell covered calls against that position and do the same thing on the way up. Okay, well, I want to sell Google at 100. Oh, well, if it doesn't get to 100, I collect the premium. If it does, I collect the premium, sell the shares at 100, and I'm back in selling puts on the other side again. So that's kind of the strategy explained. I feel like there's a lot to it. I'm trying to explain it as easy as I can. I think there is a lot to it. When you start getting into options, I haven't even talked about any of the rules yet. You think it's complicated now. Wait a second. There's so much you can get into with options, but hopefully you understand the base idea of the strategy. Now, what I'm hoping to gain out of this strategy. Hopefully you understand that now. Now, let's actually jump into the options chain. If you don't know where this is in Thinkorswim, it's the trade tab, and then you type in whatever option you want to trade here and open the options chain. Here is the position I'm in. I'm in one short put of a November 25th 92 strike. Why did I pick November 25th? I entered this trade on about October 25th. I think it was like October 23rd, something like that. I entered this trade. So gonna start going over rules now. The first rule that hopefully you've already written down or at least put into your brain: don't hold through earnings, always exit before earnings. Second rule, go a month out. I always enter a month out. So after I say this expires on November 25th and I get to get out, yeah, yippee. The next put I will go to is December 30th because that's a month out. What else do I look for? So I have Delta, Gamma, Theta, Vega pulled up here, which you can pull up via clicking layout and click that. I go a month out and I go whatever the 30 delta is. Delta is the amount that the option price will change in every point the underlying goes up. So every time Google goes up a point, this option will go down 30 cents. Those are the options that I sell. Those are really my three rules, right? Go a month out, go with 30 delta, whatever's the closest to 30 delta. Don't hold through earnings. Oh, and the fourth one being the most important. I did say this first, but only do this on stocks that you want to own long-term anyway. Those are really the four rules. So the next one I would sell currently, this will change, of course. The delta will change, but the one I would go for currently is a 92 strike December 30th put if I was going to enter this strategy right now. It's a month out. It's got a 30 delta. And then hopefully I would continue to make profit from that, be able to collect the premium from that, turn that premium into shares. I'm generating myself shares of Google into my account. And guess what? Yes, it's going to take a while, 3-4 years probably, but eventually I will get to 100 shares of Google for free. Well, I will have generated revenue via selling puts or selling options, should I say, that have generated me 100 shares of Google. Then guess what? I will still be able to do the wheel strategy just like I'm doing, and I'll be able to go sell a covered call against the 100 shares that I have. Then all of a sudden, my next 100 shares will hopefully come about twice as fast because now I'm doing it both ways. I'd be selling a put or whichever direction here, and I'd be selling covered calls against the 100 that I already own. So then the next 100 shares come twice as fast from selling option premium. Then you get to 300, 400, 500. That's the future plans and the goal, the end goal of this is to continue generating shares, selling option premium, and then as you generate more shares, you can generate more revenue, which makes you buy more shares. So that's the idea behind the strategy. I gave you my 4 rules. I talked about what I hope to achieve from the strategy, what my goals are, kind of what the idea of it is. So hopefully it all makes sense. I explained a relatively complicated strategy in 14 minutes, so I'm sure you have questions. If you do, please just ask them in the comment section down below. I answer any questions I get down there in the comment section. So make sure you all are subscribed as well if you'd like to keep up. Obviously, I will be covering this. I post my live day trade recaps every day on this channel, and I pretty much talk about how the Google trade is going in every video. So if you want to keep up and see the future of this strategy for me, see how many shares I'm able to generate and how much money I'm able to make doing this, make sure you're subscribed. Hit the like button if you enjoyed the video. With that being said, I'm going to go ahead and sign out. I will catch you all in the next one.